Just another boring week in the commodities, John.
It's the exact opposite of that. There's going to be too much to talk about. We're going to talk about how to handle this March 31st report. Is there any stellar ideas out there? And the main focus is going to be keeping the upside open on sold bushels, unsold bushels. Let's talk about the next 2 months in corn, beans, and wheat. And definitely want to get to cattle too. It's the exact opposite problem there. We got to start looking at the downside.
Speaking of problems, I got a little audio click that I can't figure out, but we're going to record anyway.
Welcome to Hedge Heads, where hosts John Prishman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, it's been a little while since we haven't opened the week with a huge market move.
Well, I meant Monday. It was a giant reversal. Was that Sunday night, Monday? I can't even tell anymore.
I guess oil was down 9. It just didn't, or 10. It just didn't feel good.
Yeah, so it was.
It didn't feel like a big move.
It was Monday. It was Monday. That huge reversal. The Trump tweet. We're always one Trump tweet away from a completely different market. And we're dealing with the same stuff. So the markets have calmed down, and that's the big thing. It was $100 before I went to bed. I woke up to texts, and not phone calls, but texts. And I knew something was up. I was thinking it was up a lot more, but no, I looked and it was down, just plunging. It was in the low 80s.
I will point out I sent you a text Saturday afternoon warning you of that.
Yeah, it's
and you ignored me.
There's been so many texts, so many everything that it's hard to keep track of it all. And the markets are hard to keep track of. You haven't heard much from us other than the podcast and the Insider on Thursday, for a good reason. This is not an easy market. We led with on the Insider. We talked a lot about what you want to be doing in markets like this is making incremental sales on the way up. Nobody knows the answers, but that leads me into what we're going to talk about a lot about this episode this is why we hedge right now. So yeah, you got the price locked in. Now we're going to be working on, we have two different groups of people. The people that listened, when we were saying courage calls, the 470 Septembers, we won't talk about how right we were, but we won't, because we didn't know this move was going to happen. But right. we put them on for this sort of move, or we were recommending it on the Insider, and for our clients.
I just want to say, one, recommended, maybe. Knowing the move wasn't why we talked about
in the private
these things. Right.
Yeah.
Because we didn't talk about these as we knew what move was coming. Yep. But we talked about these things, the likelihood that something happens was high.
And I went and looked at the first people that actually, that we talked to and then in personal conversations recommended. And it was September 4th, actually, when the first ones went on. And not that was the perfect date or anything like that, but the whole thing was, and we talked about this since September, almost every episode.
You said September 4th.
As a matter of fact, you were getting sick of talking about it. We talked about it so much.
We did talk about it.
The reason why we're suggesting what a lot of people would call courage calls, and we haven't suggested these in years, is that it seemed like corn was going to get to about that 480 price in September, 470, 480, and then nobody would know what to do. Now, we couldn't have possibly known this was going to happen, but that's exactly why we were looking at that. I figured it would probably be summer weather or anything. So you got those group of guys that have that on. They now have to decide whether to take profits on those calls and throw them on top of their sales. So let's just say they had $4.92 at the elevator. Then they bought it for 17 cents, and I think there were 34 cents. They have 17 cents of profit. This is just general numbers. They'd have to decide, I got $4.95 and I want to take that call off, and I'm going to have $4.95 plus 17. That's going to be my final corn price. Or I want to see what the summer weather holds. I got $4.92 locked in and hedge to arrive. And I want to keep this call on, and I want to see what the summer, has in store for everybody. So you have that group of people, and then you have the other group of people that are just simply making sales. So what do we do from here forward? Well, no one, of course, knows. I see you got the heat dome of death, map up.
I can't wait for heat dome talk.
Yeah, they're starting with their dog talk already. But I think, and I've thought this a long time, and you can go back and look at the podcast, and Ryan and I talked about it a lot, that this is, of all the years, a year that you want to keep the upside open in both soybeans. You remember I said 81 million acres. Mm-hmm. If there's ever a year to keep the upside open, it's this year. And corn. Although I didn't like the numbers, I still liked the demand side of stuff and the exports. We both agree on. We're moving at a very good pace, irregardless of the USDA's numbers they're putting out. Eventually, that does catch up with the market. So the theory was, over the last few years, this was one of the years that we really like to keep the upside open, and I still think that way. Even from these higher levels, we don't know if this is done here today, and we're going to have perfect summer weather, or whether this is just beginning. You want to work with your advisor, with us, with whoever, on strategies to reopen the upside or open the upside, yet still remain profitable. And we're not going to go over specifically what we're looking at here. It would involve, try to time calls on dips. Let's just say there's peace in the region in the Middle East, and we come back, beans come off and pulls corn down, and it looks attractive to re-own some of these bushels. We might consider that. There's a lot of things that we might consider, but you're going to want to try to lock this price in and keep the upside open. Another way would be just simply a December put, a September put, maybe, depending on how it, are we going to get to like a higher level where we're like $5, we're at the $5 level, $5 puts cost, 25 cents, 30 cents, and we have $4.70 locked in and are upside open. What you want to be looking for is combinations to keep that upside open. This is what's going to separate the better marketers from, well, not necessarily. I mean, it could just, if you buy a call.
Better's a strong word.
Yeah. But a smarter strategy this time of year. When you don't know the weather, you don't know plantings, you don't want to eliminate that upside. And we harp on guys thinking too black and white about this market, either sold or unsold. And I'm not saying that you shouldn't have incremental sales on the way up. You definitely should. But have this upside open for the next couple months and start figuring out ways how to do that. We're not going to dive into that here. You can definitely call us and we'll be more than happy to talk with you and go over different ideas.
And I want to stress that the main reason for that is that's going to be different for everyone.
It's going to be different, yeah.
I mean, there's probably 6 ways to do it, and which one makes sense for your operation. But we can talk through some of those ways.
Or if you don't want to, you don't do hedge derivatives because you don't know what you're going to have for yield and all that stuff, and you're not a big hedge derived guy. Are you looking at shorting futures and buying, calls, for the next couple months, like almost a synthetic put? Are you looking at just puts? What are you looking at, and what should you do? We finally have markets to talk about. There's too much to talk about, and we'll get to some of that. But I wanted to quickly go over, and then maybe you have something to say here. But I want to talk. I want to talk about straddles and what a wonderful market environment this could be for straddles. And do any of the numbers make sense? So I do want to spend some time talking about that.
When's our next big report?
And first of all, what's a straddle?
Yeah, well, first, when's our next big report?
Well, we have the renewables stuff coming up by the end of this week, which will move the market. It's not necessarily up. They're going to release the numbers. I think they've been kicking the can down the road on this since Biden administration.
Yeah.
It's finally coming out. They assured us before the end of the week. So that'll move the market, and then of course the March prospective plantings. So we have a very volatile report historically, or can be.
Yep.
It's more volatile than not.
It's been nothing the last 2 years, which can mean that it could be fairly explosive this time. And
what numbers mean anything? We don't even know. If you see 93 for corn, that's going to be bullish. There isn't too many numbers that make the beans bullish. So it's going to be an interesting report. Do straddles make any sense this year?
Okay, now tell me what a straddle is.
Buying a put and a call. You do not have to have the correct direction. You're buying the downside and you're buying the upside, and you're doing it at the money. And then if you're away from the money, it's strangle. You can either buy it or sell it. And in this case, it would be buying volatility. It would be another way to say it. If you're selling it, you're selling volatility. That's when you think you think that the premiums are pumped up and it's going to get calmer. You're selling it, and then you open yourself up to substantial risk on both sides. You just think it's going to be in that range. And then you have when you're buying it, which I talk about this strategy often. I like it. I don't do it near as often as I should. These haven't been really great markets to do it in.
Yeah.
But volatility is picking up. Are these options underpriced, and are they going to get more expensive is really what you're betting at. And then if you get a large directional move, there can be very good money in it. Anyway, we're headed to very unpredictable times. And we have a lot of reports. We have a lot of stuff going on in the Middle East. And let's go over some numbers. Let's look at what
That's what I was going to say. So what are some examples of straddles that are out there you'd look at?
80. I'm looking at. Okay, so let's start with May. Let's start with May beans, because beans tend to be the most undervalued at all times. Puts and calls.
31 days in the May bean options,
and then basically at the money, put and call. And you don't have to do at the money, and we're definitely not recommending doing this. We're just going over the numbers. 48 cents. So what you're saying is that you believe it's going to move out of that 48 cent range either direction in 31 days. Now, it doesn't have to do that. It can be more volatile next week and only have moved 30 cents one direction, and it's still going to be profitable. Instead of costing 48 cents at the money, now it costs 63 cents, and you would profit. So you just need volatility to pick up in 31 days. That one feels like it's got its work cut out for it. But it's not a bad price. It's around 48 cents. So our quote didn't work. I don't know what's going on there.
So yeah, I mean, we're just giving ballparks, because if you listen to this Thursday, it could be entirely different.
Yeah, these aren't recommendations. These are are ideas in markets that are volatile.
Yep. So the negative is for the next 2 to 3 weeks, beans could stay between 11.40 and 11.70. Barely moving over the next 3 weeks. I mean, barely moving for beans. I want to clarify.
Yeah,
that.
It's been that way. It's been a bad bet so far because it's been very, very quiet.
Yeah. So, but best case, I mean, you have a break like last Monday.
Yeah, 70 cents.
Yeah, would make it very profitable.
Yeah, so, that would wake it up.
Yeah. I just wanted to go over.
But
what could happen?
I wouldn't sell it. Personally, but I mean, it's a hard buy too, if that makes sense. It just seems like, but then you start it gets a little more interesting with June, which is going to be a cereal option in between. Yeah. It's going for about 65 cents, and you have 59 days on there. So it's at least, you got 2 months essentially for it to move 65 cents. That seems a lot more likely than the May at 48 cents. It doesn't seem like it just seems like that those 30 days are like gold. Like those 30 extra days, that's especially with what's going on. Either there's issues resolved in the Middle East and it's getting better and trending the right way, or it's trending the wrong way and going substantially higher. I mean, that would be where the beans would be. And then probably the most interesting one of all is July at 82 cents for 94 days. So you have all the stuff that's going on now with multiple reports, and then and the Middle East. And then you have the summer weather also involved in that one. So even though it's the most out of pocket at 82 cents, over $4,000, beans are very likely to escape that range by July. I certainly wouldn't be a seller of that in July right now, but I still have a hard time shelling out $4,000 per straddle to own it as well. But those are it's always interesting. We've talked about this in the past, and we've gotten a lot of feedback. So guys seem to like this idea, and I know why. It's very appealing. You finally get a break. You don't need to know the direction of the market at all. You just need to know if it's going to get more volatile or not. And there's a lot of gray areas in there.
I was gonna say that's not always easier than knowing which way it's gonna go.
No, and the truth be told, selling these more often than not makes money. I of course, just generically saying, you couldn't pay me to do this in beans. Guys will probably laugh. They probably do it for a living, for all I know. But beans have a way of wiggling out of that range very easily.
I would say if you paid me $4,000, I would just walk away with the $4,000. I would not sell this.
I got one for you. How about this?
Okay, I'm ready.
How about corn at 46 cents in July? Seems a little rich to me. Means it's going to be on 46 cents of either side of where it is right now.
From 470?
From 470. So let's do the math there. 470 plus 46 cents.
To 5.
just under 520.
Yeah, or you're going down to 420.
Yeah, which is very
420 something.
Which seems very unlikely this time of year for corn. You know what I mean? Because it never did go higher. How about a guy sells the corn one that appears overpriced and buys the bean one? I meant, what could possibly go wrong with that? Other than there's an acreage report and it looks like there is not enough fertilizer for corn, and besides that, and oil.
Aside from that,
besides that, what could possibly go wrong? Right. But I did cross my mind.
It is intriguing.
It is, because you get 46 cents to pay for that straddle. You just need corn to stay somewhat calm, and then you have over half your straddle.
So your July corn straddle would pay for your what? June? Is it almost even to the?
It's
back to the May.
It's 46 cents for the July, and you're selling it, so you get 46 cents in your pocket. You turn around and buy the 82 cents one in beans. You're basically betting beans are going to be more volatile than corn is.
I don't want to say anything's. Never mind.
This is definitely not a recommendation.
No, do not do that.
It's
I can't chatting with us.
I can't wait till Theta Farmer weighs in on this one. He's gonna laugh. He's gonna laugh at it. You'll enjoy that one.
Well, so here's a theory though for you. So the May bean straddle is 46 cents. Your July corn or 48.
Yep.
Your July corn's 46.
No, you don't. You want to sell summer weather and not have summer weather in the 48. Terrible idea.
No, I'm saying you don't need to hold it.
Well, I know, but still, this is going to hold the 46 with the July and the June weather will hold its value much better than a May. May will bleed out very fast on you. So even though,
if you get volatility in beans,
you wouldn't be. The July has weather.
Then you
May
just
doesn't.
flatten out your.
Yeah. It's not. We're just kidding around with this. We're not going to do any of this. And a shortcut to this would be buying 2 corn, selling 1 bean if you think beans are out of line. That's the actual spread. I'm not that interested in it. I don't know what these numbers are going to be. Buying 2 corn versus 1 bean is basically the bean corn ratio spread. A lot of guys, when they do that spread, they buy 1 corn and 1 bean, even though it's supposed to be 2 corn to 1 bean.
Yeah.
I'm just not interested in any of this stuff. It's fun to talk about and get ideas flowing. But
so let me ask you a question. Why do you like the corn wheat spread but not a corn soybean spread?
The corn wheat spread, because it's a feed relationship and beans don't have that with corn. It definitely exists, but it can get with beans. It can get way out of whack as it can with wheat. I like long wheat, short corn when I do it. I like when wheat gets underpriced versus corn. I don't like when wheat gets overpriced versus corn. Much more dangerous. Just like beans here. Like beans are more dangerous than corn is. So if beans get underpriced relative to corn, I would like that. But it's hard. It's always hard when the more volatile one, beans and wheat, are your short legs. But again, you go look at those charts, you're going to see corn versus wheat bottom often in between 50 and 0. Like that's pretty extreme stuff where, the wheat can go, it's been $6 above corn. It can blow out the other side. So, we've really dived into a lot of different things here. But what I think the point is that these markets create a lot of volatility and they create a lot of opportunity and they create a lot of creative ideas for hedging. This is finally markets that we can deal with, and we're going to have a lot of ideas. If you want more information, call us and we'll go over specific stuff that we're recommending. But we've been quiet for good reason. The story on this stuff is changing hourly. Impossible to navigate, and we stick with make incremental sales on the way up at price levels that make sense for your farm. And that's the advice that we're giving right now. But it won't be too long before we're going to be in the actual recommendations, and we have a clearer picture. At least in my mind, I'd be more comfortable. So that is our cash sales recommendation, is incremental sales on the way up, and as far as next year's crop as well. And I think that guys don't need to be told that. I think that that's kind of an automatic thing that guys, when they see a better price. But what I really wanted to talk about, and I got away from, is how everyone's given up on this corn crop, and which we've talked about how many times. Like everybody gave up on this new crop corn back in October. And then that January report came out, and it was another body blow. Like, I got to get rid of this corn, this whole crop corn. I got to get the next year's corn. I haven't heard that sort of talk in years. Like this urgency to get a bad price in corn. And I think it was just the fear that took over. And guys really want, and not that it couldn't have turned out that way. Like we could have a lot of bad news. Corn could be stacking up. Demand could be bad. But demand hasn't been bad. And that's really why I like the upside open, is the demand story in corn is just too big to give up on corn. Not that I have all the answers. I clearly don't. And then you had something that we couldn't have possibly predicted pop up. But my point is, I don't know why everybody gave up on corn this year. I think they fell in love with that 2.1 billion bushel number. I think they remember the last 2 years holding corn hasn't been great into summer. And I think they remember the last 2 summers where it's been perfect from day one. And I'm saying that's the anomaly. That's not the norm. And we're going to see it go back to a normal cycle where we're going to have these windows where, there's a little bit of hot and dry in the forecast. Now, there's a difference between hot and dry in the forecast and burning up. See, people think you need it to burn up to have a higher price. You just need the threat that it's going to happen. We just simply haven't had that in 2 years, which is incredible.
Talk heat dome.
Yeah, the heat dome.
I can't wait for the heat dome episode, John.
It's just pure bad luck, and it's cyclical. Call it what you want, that the weather's been perfect from about day one for the majority of the U.S. That's unlikely to continue. Thus, why would you take 460 when 450 basically has been readily available for the last 2 years for most of the year? You know what I'm saying? So why give up all that upside? Not that we haven't figured out. I just don't want guys to give up before we can see what this can actually do. And now we have this tailwind from energy, and fertilizer, which makes it a whole different thing. And we're not going to get in. Ryan and I talked about this. We're not going to get in and give you our hot takes and all this. I've had so many. I'm so sick of people's hot take. Everybody's a Middle East expert all of a sudden, or an oil export, or a Straits or Straits of Hormuz expert. It's exhausting. Watch the oil price, and that's the story, in my opinion.
Or if you want that content, there's plenty of other places.
There's plenty other places. You can listen to a million other podcasts that are going to do recaps for you. They're going to talk about the fertilizer. That's not what we do. Generally, these rallies are like these situations are all faded. This one might not be that one. We're just taking it day by day and working more on the upside, keeping the upside open, and not making decisions that affect your farm for the next 2 years at low prices. That's where our concentration's trying to be, and we're trying to be helpful that way. So hopefully it is. And again, we don't have everything figured out by any stretch. It changes every day. But I do know that these markets provide very good opportunities where you hear your neighbor in the cafe say, hey, I got 620 corn locked in for the next year, and everybody else is getting 4. These are generally the opportunities when these windows happen like this. We're just at the beginning of it, and we don't know what direction it's going to go. It could go a lot of different directions, but there's definitely a bid under commodities, and I think this is a different market than what everybody already thought it was going to be. And that's end of, it's not a rant. It's just a tale, if you will. Yeah. Tale on why I wanted the upside in corn open.
I absolutely love it. I have a completely unrelated question for you before we wrap up.
Go ahead.
Is silver going to zero?
Yeah, this reminds me of 2008. I sent you that. I sent you that Twitter. That's a pretty good one. That one I sent you.
Yeah.
No, it's
You should probably explain that if you're going to say it on the.
Well, it's easy to you start scrolling Twitter or the news now, and just everything's doom and gloom, and the world's ending, and the silver and gold guys can't understand why it's not going to the moon. But when money shifts around in markets, they usually take it out of the profitable ones, reallocate it to maybe an underpriced one. There's no bank runs, there's no anything happening, so it's like maybe it just got overpriced, and that's not the hot commodity anymore. People don't like to think in those terms. So it's just cyclical. That's where a lot of the profits were. It probably got overheated and kind of came off. Whether it's over or not, I think is where you really want to concentrate.
You're right.
You'll find this happening in beans and corn and wheat eventually, because the funds just got loaded to the gills long this stuff, and cattle. And that brings me to cattle, which we definitely have to talk about.
Before you do that, there's a reason I brought silver up, and it has to do with what you were just talking about. Is I have been having a lot of conversations about where does the money go?
Yeah.
Out of silver. Well, just because however many billions are not there doesn't mean that the money ever existed or disappeared, unless you were out you got out at the top because you were already in, or you sold at the top and now are getting out.
Yeah, all these
there. Like if I bought silver in 2012 and it went to 115 and now it's 60, doesn't mean that I lost the difference between 115 and 60.
No. I mean, it's not your money until you actually get out of the market. Just like the funds, everybody thinks that they're all knowing, all seeing, and they got very long, the soybean complex, to the point where we're putting recommendations out soon to be on the other side of it. But it's like everybody thinks these guys know everything and they make all this money. The smart ones will get out at the top and you're near the top, and that is real money and it's in their account. The other guys will write it back and then some to losses. Yeah. Like it's not realized till you get out of the market. It's not your money until you get out of the market. And I think that also gold and silver are showing the direction all this would actually go if it were to continue to escalate. Meaning if oil were to actually go to 120, 150, and I have a feeling some people secretly, grain guys, are cheering for that because they think that's going to pull grains up. What happens is it pulls grains up temporarily, and then everything flushes because people buy less of everything when oil goes soaring high. And that's why cattle's on thin ice up here, and the cattle guys are nervous about this. People spend less in those environments, not more. This whole idea oil's going to 150 and they're going to panic buy all this food. Sounds good on paper. That's not what's happened in the past. In 2008 is the closest thing that we had to that. 70s would be another thing. It all leads to lower grain prices, not higher, but not necessarily initially. Corn did go to 840 in 2008. Before it went to 297 by harvest time.
So there's a perfect example, though. If you didn't take advantage of 840 because you were waiting for 10,
you might have got 297.
You might have got 297.
Yeah, you probably didn't get that either.
You didn't lose that unless you actually sold it, right? Or, I mean, obviously, as a producer, you're long that commodity. So if
you've lost the opportunity,
you lost the opportunity to take the advantage of that. Have a plan.
Yeah,
that's my point.
Yeah, and that's what we're trying to do is keep the upside open in grains and find strategies to do that, and that's what we're going to do in the days ahead. But now on the cattle side of things,
let's talk cattle
before we close it out. The oil is going to affect cattle, but in a negative way, or historically it has. And I think that's probably cooled some of the bidding off for these cattle. Then you have industry problems with the Greenlee, although they're still running. They have a strike going, but I don't know, do they have the scrubs in there? I'm not sure. I haven't even kept up on it. I know they're running to some capacity. There's rumors of another one possibly going dark or on strike. But you're getting plenty of warning signs here that you should be looking at protection up here. And, even the cattle on feed report that showed slight expansion from the last report or last year, and definitely more placements than last year. Doesn't mean that we're expanding rapidly, but these are all just dinging up the cattle market a little bit at a time here. At least entertain the thought of covering stuff. But we kind of covered we've covered a lot of bases here. But I know oil at first will bring everything up and then it crashes everything. And that's what's happened. Is that what gold and silver are telling us? Kind of a long way to answer your question. It might be. And that's the way in 2008, I remember perfectly. Gold and silver went soaring when it looked like Bear Stearns and Lehman Brothers and everybody's going, and there was going to be a bank run. Gold and silver went soaring for 2 days and then crashed harder than you could possibly crash any other market. So when push comes to shove, money gets pulled out of markets to pay for margin calls in other markets. And it's just all a panic. So up first, then down. But right now we kind of got the stagflation thing going on. But if oil were to accelerate, it would be negative everything eventually. So you would have to ride the wave, market, and then it would crash and burn. Or at least that's the way it's worked in the past.
Absolutely. Well, Jen, we better wrap up there.
Yeah, we stratified this podcast here. It's fun. It's a strategy that a lot of people don't know about, and we brought it up in the past. And that if there's been phone calls on anything, the most phone calls definitely is on that. But it is fun when you buy both sides and you can't be wrong. You just can be wrong on volatility.
This thing can't be wrong as a...
Can't be wrong.
Can't be wrong. Loaded.
Can't be wrong on direction. You can definitely be wrong on paying for that, what you paid for it.
Yeah.
But you can't be wrong on direction.
Right.
But
you just need some direction.
Yeah, and if there's too much to talk about in this podcast, if you want to hear more from us, we'd be more than happy to talk with you. Give us an email or a call. And 218-731-1578.
Thanks, John.
Sure.